the board. So when are we going to use a straddle? Obviously, we can't just use it as in the normal course of our investing and trading. This is more of a special situation type of trade. When you're expecting a large movement, but you don't know which direction that large movement is going to come from. Normally, this has to be some type of event-related type of situation. It's going to have to be an earnings or waiting on an FDA approval or something along those lines, because under normal conditions, the stock will probably not move enough to make the straddle profitable. Normally, you need an over movement of the stock, an over performance. In that case, then your straddle will work, but the odds of that are very limited. That's why the straddle is really confined to event trading. Now, in a low volatility environment, such as one of those kind of like, constricting wedges where both sides of your chart are coming in and meeting at a point, this might not be a bad time to use a long straddle. So there are a couple situations, only really one charting situation, where the straddle comes in. And that is when you have some type of constricting triangle where it's equally coming in from both sides. Remember, when you're looking at an ascending triangle or a descending triangle, we have an area that's coming down or up and in, and a flat area. We know which direction the stock is going to eventually bounce to. We don't need the straddle there because we know which direction the stock will go. Here, if we have an equal triangle that's constricting, we don't know which side's going to win. The straddle might not be a bad idea there, but you better make sure that vol is low before you do it, because if not, you're going to be eating premium in an ugly way. Normally, where do we use straddles? In front of earnings, in front of FDA announcements, any type of news-related announcement that is something that we know when it's coming out, so our timing is going to be right on the money, and something that we know is the type of news-related story that can really move the stock. Now what we're going to do is we're going to take a look at the chart identification of that constricting triangle, because really that would be the only time from a standpoint of charts that you'd use the straddle. The straddle normally is a position we use when we see something from a standpoint of fundamentals, earnings, FDA reports, maybe some type of legal news. But when it comes to charting, you've got to look for, or not actually look for because they're hard to find, but when you do run into an equal constricting triangle, the straddle will be for you.
Well.
I'm back.
You are.
Yes, I am.
Look who we have here.
I'm here. So did you learn something?
Batman.
Did you learn something, Robin?
Whoa. I don't wear tights. I'm not robbing anybody. But I did learn something.
That's good. That's very good. But now we have something more to learn.
When we're going to identify these
we have to be able to identify
breakouts.
This symmetrical pattern.
Okay. Well,
the symmetrical triangle.
I'll show them the symmetrical triangle. Could be before an earnings announcement. Maybe it's not. Maybe it's just a triangle.
Could just be that way.
Volatility will be low, and at some point it spikes up.
And the stock moves.
Okay.
Well, one way or another, and we don't know which way. That's why we threw the straddle on. So why don't you show us that charting pattern?
Okay, I'm not going to waste any more time. I'm out of here.
See you.
Like Spider-Man does.
Vamos.
Okay, so we already discussed when a stock is consolidating after having high volatility. We discussed how to take advantage of the decreased volatility. Now we're going to do the opposite. We're going to talk about the straddle. And with a straddle, what you want is you want to find a stock that is consolidating, and you know that it's about to break out to the upside or to the downside. And you're going to find that in a symmetrical triangle. So here's what you're going to do. Basically, we're going to be buying, and we're buying the puts and the calls. So we want it to break out big to the upside or big to the downside. So what we have here is Pfizer. The first thing that you're going to do, remember, internal strength system students know this, You have to take a synergistic approach to investing at all times. You might see 1 or 2 or 3 different signs. You want to see loads of signs popping out at you telling you it's the right thing to do. Stack the odds heavily in your favor before you make the trade. Well, you could see the market was tanking here. We bottomed out in November, and you could see that there was big moves. Now for Pfizer, these 1-point moves in a day, or even 4-point moves in the matter of 2 weeks, that's a big move, especially on a percentage basis from 18 down to 14. But you can see that obviously one of the key price points is right here at about $14 a share. Now this becomes an even more key price point because of what was happening in the market. Wherever the stocks found their bottoms or their tops when the market was tanking like that, that's where there's going to be a lot of strength or weakness. So you can see we're going to keep this in mind. Even though we're trading this small portion right here, we're going to open up the chart, kind of zoom out, take a look at the big picture. We want to know where we are within that big picture. So you can imagine right here from the things I've told you in the past that there's a support level. That support level is broken. You can see that the stock dropped, and there's more resistance here where the old support level used to be. Let's take a look. First thing that we're going to focus on is we're going to take the bottom. This is a symmetrical triangle that it's forming, and then it moves back up. The way that we know that is we take some trend lines. What we're going to do is we're going to connect this low to the next higher low and extend it out. We're going to take this high, connect it to these 2 highs, and extend that out. You can see it was tested again. Usually when you have a symmetrical triangle, you'll have a breakout about 3/4 way through this triangle. So when you have a market that's highly volatile like this one, and then you know that the market's starting to feel a little bit more calm, a little bit more relaxed, and you really feel that when it happens in the air. What happens is it consolidates. You see the volume starts to consolidate too. We'll talk about that in just a minute. But here you have your symmetrical triangle. Now the first thing I want to do is just take a step back for a second. I want to look at this $14 price point. 14 and 15 are both very important levels. You can see we found support at 15 here, slightly broke it, and then ran back above it. So around $14 or $15, that's where our key price points are going to be. You're going to see that once we broke through 15 to the downside here in the beginning of February, end of January, you could see that at 15, where we used to have some support, the market tried to rally back up and found resistance right here. It kept banging its head right here against the ceiling. Now what you have here, it might be kind of difficult for you to see because it's a small window. In Western technical analysis, we call this a gap. The market gapped down. In Eastern technical analysis, Japanese candlesticks, we call this a window. And what this is a continuation pattern of whatever trend was happening prior to that. And you can see this is a downtrend. Now that you have a window, what this looks like is a continuation pattern about to happen. Typically what happens when you have a window is that window is closed. So what you'd look for after a gap down, even if this rallies, a lot of people don't know this, so they'll buy into it. And it's unfortunately called a sucker's rally. It rallies up, people buy into it, that's what's causing the price to move up. But people who study technical analysis know that this window or this gap is closed and then moves down. You can see just by this one candlestick alone right here, this is a gravestone doji. If you study Japanese candlesticks, you'll know that's a gravestone doji. It's a very potent chart pattern that basically stalls an upside or a downside movement. This is a quick, short-lived upside movement. Close the window. All these different things are coinciding with one another, and then the market starts to move down again. Now you can see here, remember, keep these price points in mind because we're going to use them later. So basically the whole point of this pattern is that it's a consolidation pattern. So that means the options that were very expensive are now becoming very cheap because the volatility that was priced into those options is reducing significantly. So you see lots of volatility here. You can see these, how big the bodies of these candlesticks are. That represents the difference between the open and the close. And you can see those get smaller, kind of consolidate here. You can see the market sells off again in the beginning of 2009. They start to get bigger. And then a big bounce here. The market did the same thing that you see Pfizer doing. But then you see they start to shrink. The candlesticks themselves start to shrink. And the trading range narrows. And that's what a symmetrical triangle is. You have lower highs and you have higher lows. And it consolidates. So what you usually see with that happening is the buyers and the sellers are basically agreeing on the same price. Over here, the buyers and the sellers significantly disagree. And so the options are expensive because the market can go or the stock can go in any direction in a big way. So they price that into the options. Here what's happening is the options are getting cheaper in terms of volatility. Okay, so again, the trading range is narrowing. The daily trading range, each one of these candlesticks is small. The daily trading range is narrowing, and the monthly and weekly trading range is narrowing. At the same time, volume has dried up. It might be difficult to see this at first or to understand that volume's dried up. So what we have here is a 50-day moving average on the volume. So wherever this pink line horizontally is going across, that's the 50-day moving average of the volume. You can see the volume here kind of is below that 50-day moving average. The reason that's happening is because the buyer stopped buying so much, the seller stopped selling so much. They're pretty much agreeing that this is the right price to pay between $13 and $14 for Pfizer at the time. Now, what you see here is a MACD buy signal. Now, MACD buy signals are important to focus on. They're a little less potent when you're talking about a stock or a market that's trading flat. They're much better when it comes to finding bottoms or tops within trends that are strong trends. You can see that here's a downtrend, stock bumps up, and then kind of reverses higher again. You can see the MACD buy signal right here where the green line crosses from below to above the purple line. It's hard to see right here because the market was pretty much flat. But after seeing that happen and after seeing the volume dry up, when you see this symmetrical triangle, you know that at some point this is going to break to the upside or it's going to break to the downside. So what you do is you initiate your straddle when options are nice and cheap. Because when you own a straddle, when you're long a straddle, you're buying the call and you're buying the put. So you're paying. It's a debit trade. You're paying on both sides. So you want to do that when options are nice and cheap, and they're going to be cheap when the volatility is down like this. Whenever it breaks to either side, volatility is going to expand. Now, you're either going to make money on your puts and lose on your calls, or you're going to make money on your calls and lose on your puts. But what you're hoping for is a big move in either direction. And typically when you see a symmetrical triangle, it ends up with a big move in either direction. Now, we keep this key price point in mind because once this breaks to the upside, remember, we initiated our straddle somewhere around here. We know that with symmetrical triangles, or ascending or descending triangles, by the way, usually the breakout or breakdown happens about 3/4 of a way through the triangle. This one looks like maybe it went a little bit past that. So we're initiating our position in the straddle right around here. We get a break to the upside. We remember that this is a key price point right here, so we expect to find some kind of resistance there. The question is, does it break? And if it does break, we want to look at the volume and we want to see if there's a lot of conviction in that breakout. So what we see here, and we also want to study the candlestick patterns. So what we see here, heavy volume buying on this breakout, but it's a weak breakout because you can see as soon as it breaks out, first of all, the heavy buying, first it stalled at the end of the day. The close was at this key price point, right about 14 bucks. And you can see all the candlesticks after that have very small bodies. That shows that the market's indecisive. That shows that the market opened and it closed right around the same price. So during the day it might have ran up, maybe ran down, but right at the end of the day it closed at right about the same price that it opened. And the open and the close are the most emotionally charged parts of the day, and that's why the close is the most important price to focus on when studying a chart. So what I would have done is I would have initiated my straddle here, knowing that the price range had consolidated, the volume was significantly reduced. We see the price pattern and the chart formation forming right here. We know there's probably going to be a big break to the downside or to the upside. So we initiate our straddle. We make about a point and a half on the stock. So what you want to look for when you get to this key price point that we established here with the support and then resistance and resistance here, we want to be very careful when we see this breakout, and we want to look to see what happens right at this key point. Now remember, volume equals validity. So while you see heavy volume here, don't think that that's a breakout on heavy volume, because it's not. Heavy volume, this means that whatever you see here is very valid. What we actually see here is that we're having trouble breaking through 14. We closed right at 14 when we tried to break out on the first bar of heavy volume. Then you have a second bar of heavy volume, and although the market moved up intraday, it closed right near 14, slightly above 14. And what you have there is an inverted hammer, also known, in this case, it looks like a shooting star. And you have to be very careful with that kind of a price pattern because it's usually a reversal of a trend. In this case, it's a reversal of the upwards trend. So that's where you want to take your profits. You want to get out of the straddle at that point. You probably would have made a nice percentage gain from the time you initiated the straddle here at about 13.5. Looks like you got out of the straddle at about 15, maybe 15 and change. And that's just one example of how to take advantage of a straddle.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.
Very nice job. I liked it a lot.
Thank you.
I like the way you stayed consistent with the indicators that you use. I mean, I know a lot of people that are out there, you know, they sometimes use this indicator and that indicator and this one and that one, and oh, if these two don't work, then let me see if this one will work to fit what I want to see. You have to stay consistent, and I see you do that.
Thank you, thank you. That's a real compliment. You know what makes a good technical analyst? It's not so much, you know, knowing the indicators and understanding what they mean. That's the easy part. But staying consistent with the indicators that you use is one of the most important things. And you know what I do? I have a system, the internal strength system. It's a top-down technical analysis approach. They're just seeing the charting part. It's just one portion of the way that I approach this, but I'll see what the market's doing, decide if I want to be more bullish or bearish. Then, you know, I'll look at sector hunter alerts, and I'll decide which sectors I want to take my bearish positions on or my bullish positions on. And then I'll get to the chart patterns, which is the only thing that I'm really showing them there. And just staying consistent with a system is the smartest way to invest. And enough about me. Now you talk about me.
Okay, well, I found you to be highly intelligent.
Yes, go on.
Unbelievably good-looking.
Stop it.
Oh,
You're
come
just
on
saying
now.
that.
I am just saying that. So, other than that, what these people need to know is they need to know that whatever little brand of group of indicators that you use, you've got to stay consistent with them. Don't drop one out and only use one time and use another time. Yeah. You have to use that group of indicators consistently, time in and time out. And I like how you found those symmetrical triangles.
Good, good. Well, I'm glad. That means a lot coming from you.
Well, there you go. You've got it.
Now, why don't you show us, you know, a couple of, you have any other tricks up your sleeve? You want to show us how you might want to adjust these positions?
I've got a couple tricks up my sleeve. Well, you know,
down,
we definitely have to get out of these
right.
things fast. And I'm going to show you a couple little things we do to get out of these things fast, but still actually keep a little of the position on.
All right. Well, I'm excited. As you can see, look.
Yeah, it's just overwhelming.
Okay.
So why don't I just go do this?
All right, go for it.
All right.
Excite me.
Well, now that we know how to find one of those equal constricting triangles, that's pretty much the one charting formation that a long straddle might be viable for. Most of the time, it's going to be off of some type of fundamental analysis, and it's almost always in front of some major news announcement. Now that we've found a situation where we're going to use our straddle, let's take a look at the process of selecting the option. We need to choose the at-the-money option for two major reasons. Number one, the delta. Only the at-the-money strike will have a put and its corresponding call with 50 deltas. Makes perfect sense. We know that if we're looking at an in-the-money strike for a call, it's going to be an out-of-the-money strike for the put. Their two deltas won't nullify each other. If we look the other way, same situation. The put will be in the money, the call will be out of the money. Again, no delta nullification. So, the only option on the board, the only strike that has both a 50 delta call and a 50 delta put, which you need to become delta neutral, is the at the money. That's the one that we're probably going to select, because I don't want to choose an in the money straddle or an out of the money straddle, because they're going to give me a delta. I don't want delta because I've already admitted to myself I don't know which way the stock's going to go. I need a delta neutral position. The only strike that's going to give that to me naturally, right off the bat, is the at the money option. Secondly, I need gamma. If I'm trying to take advantage in a delta neutral way of a stock moving in an unknown direction, then I can't use delta directly. I need to find something that's going to get me the right deltas when the stock goes down and the right deltas when the stock goes up. And the only thing that's going to acquire deltas for me is gamma. Gamma is going to acquire deltas for me. With that said, we know that gamma is biggest at the money. And if I need big gamma, then I need to use the at the money option. Now that we know this, I have found my fundamental reason, upcoming earnings, for instance, or I found a chart that was that of an equal constricting triangle. And I said to myself, hey, here's a good time to put on a long straddle. What am I going to do? I'm going to buy the front month, or at most the second month at the money call and put in a 1-to-1 ratio. Why would I buy the second month? Because what if the front month only has a week left and the news announcement is going to be possibly the following week? I might be looking at having to have a little more time. The second month option would be sufficient at that point. But we sure as heck don't want to go too far out. Definitely no further than your second month option for your straddle. And we also need to be able to adjust the position as necessary. Keys to success. Obviously, as much as I normally need really solid technical analysis, most of the time the straddle is coming down to fundamental analysis. Some type of news-related event where we know when the announcement's going to be made, we know the announcement has the potential being good or bad, and the stock could react in either direction in big fashion. That is what we need to find. If we don't see that, then the straddle is probably not the strategy you want to be using. You need to be very accurate on your timing. The straddle gets killed in decay. If you're long it, that thing is going to bleed like a stuck pig. You got to make sure that your timing on initiating a long straddle is very, very accurate. You've got to know and understand the volatility levels in terms of, are we at a high volatility situation or a low volatility situation before entering. If you enter a long straddle in a high volatility situation, you are going to be taking on a boatload of extrinsic value. That's going to force your break-evens even wider, which gives you less probability of success. Secondly, if vols are already up and they're near their highs, due to mean reversion, we could be pretty doggone sure that soon as this announcement's over, that volatility is going to get crushed. And as it comes back in, we're going to be losing money. We don't want to be putting these on in situations where we already have high volatility. Review your little section on volatility and look at what tools can be used to help us determine what volatility level we're at, high or low. Do understand that we don't have a lot of time with this position. This position's got to get rolling fast. And if that's true, then we've got to make quick adjustments, whether we're going to close it fast, whether we're going to roll it, we're going to move it, whatever we do, the adjustment must be quick because time costs money here. We are in a situation where time is not just working against us, it's working 2 times against us. And we need to be very, very cautious of that. Now that we've identified the type of charting position that the long straddle would apply to, remembering that mostly it's more of a fundamental type of situation, let's talk about what we're going to do once we're in the straddle. First, what if the stock goes up? Well, if the stock goes up, we can roll our long call and leave our long put alone. Remember, with the stock going up, the put is going to see a loss. The call is going to be making money. What we need to do is whatever profits we can get out of that call, we want to lock them in and remove any further risk than the risk that we didn't already start with. So as the stock trades up, we're going to forget about the put. Don't worry about it. By the time you get to react to losing money in the put, the money's going to already be gone. We leave the put alone. The put is going to act like a lottery ticket. We're going to roll up the call instead. The call suddenly becomes the heavy of this position. What about potential morphs? Well, you know what? If the stock is going up and we have an opportunity to have that thing run, then we want to let it run. We don't want to change anything. We need the stock to move up big and fast, and the best way to take advantage of all the profit that we can get from the stock running up is to simply roll that call up. There really isn't anything that we want to change here. Closing alternatives, at some point in time, if we feel the stock has had enough run up, we could always sell out the call. Remember, leaving the put as a lottery ticket. Quite often when we're talking about news anymore, fundamental news, the stock normally has some type of first reaction to the headlines, then later sinks in to read the entire story. And if what they see in the story doesn't match the headline, then you're going to see a movement where the stock runs up and then the stock comes all the way back. If that happens and you dump out your call when the stock ran up, you've got profit. Now with it retracing back, the put comes into play. That's normally the best way for you to make money in this situation. Leave the put alone. It's a lottery ticket. Let's play the call when the stock goes up. So here we are in our long straddle. And sure enough, boom. The first knee-jerk reaction to whatever announcement occurs is that the stock starts to run. What we're going to do is we're going to pretend like we don't even have the put. We are going to start rolling our call following the stock. Remember, if it's a news announcement, most news announcements are made either after the close, before the opening the next morning. There is probably going to be some type of gap off the news. That's why I'm saying that odds are you won't be able to respond quick enough to trying to sell out the put before you lose value. The stock, if it's going to go up off the news, will probably gap up. And in that gap, the put will lose enough value that it probably won't make a difference for you to just leave it on and use it as a lottery ticket. The call, however, can be rolled up, strike to strike, and finally sold out when you think the stock has had enough of a run. You can always get lucky because after that, the stock might go down. If the stock does go down, well, off the bat, we're doing the opposite. We're now, what? Rolling our put, leaving our call alone, just in case if the stock on knee-jerk reaction goes down and then spikes back up. These type of situations occur. And quite often what happens is, after the gap down, the option that's in the wrong direction is normally pretty cheap. And if you sell it out, quite often what you see is the stock then recovers back or retraces back in the other direction, and that option you sold out for nothing is now in play. And you say to yourself, why did I sell that thing out for 30 stupid little cents when I could have just left it alone, treated it like a lottery ticket, and really made some money off it? Normally what happens is when an option is cheap and it's lost just about all it can lose, a professional trader will just leave it alone. They'll accept that little bit of extra loss in exchange for the opportunity to have a quick retracement of the stock and value banging back into that option. So we're leaving this option alone, not because we're ignoring it, because we're hoping that it comes into play at a later time. So here we are in our long straddle. The stock starts to trade down. We're going to leave the call alone. We're not ignoring it. We're just letting it hang out for a while. It's going to become a lottery ticket. As the stock starts trading down, what we can do is start to roll our put down. We need to trade this put as if it's now simply a stock replacement put. Same situation. If the stock started trading up and we started rolling our call, ignore the other option. We've got to trade the option in the direction that's right as a stock replacement. Stock runs up, ignore the put, trade the call like stock replacement. Stock runs down, ignore the call, trade the put like stock replacement. And what do we do when we trade a single individual long option in a stock replacement type of fashion with movement? We roll. We roll, we roll, we roll. Finally, when we think the stock has gotten beaten up enough and it looks like it's going to mount a little bit of a rally back, we can always just dump out the put and hope that our call comes into play. So from a mechanism of up and down, we're going to concentrate on the option that's doing the best for us and forget about the other one. Now, what if the stock stays still? Well, let me tell you something. You're going to get your butt kicked. That's just the way this strategy works. It's kind of like one of those big home run hitters that strikes out when he doesn't hit a home run. Most of the time he strikes out. Every once in a while he gets a home run. So do understand, if the stock doesn't move, you're wrong. If you can sell out and close the position and get anything back, fine. Quite often, the problem with this strategy is when you are wrong and the stock doesn't move enough, the value of your straddle quickly goes to zero. And that is a problem. When you're wrong in this strategy. It's hit or miss. It's homer or strikeout type of scenario here. So what we want to do is, if we are wrong, lick your wounds, because it's going to be very tough making back what you just lost. You can't turn long options into short options. So when we're in a premium outlay strategy like the straddle, knowing that we get hurt if the stock stays still, if the news announcement comes out and the stock doesn't move, there's just nothing we're going to be able to do. We're going to get punished for being wrong. So here we are. We're in our straddle, and we're wrong. That's it. It's over. You've lost what you lost. You're done. That's it with the straddle. Now, do understand, there is a time and place for every single strategy we talk about. And the one thing you've got to realize, like a carpenter going to work every day, you want to make sure that you've got more than just one tool. You've got to have a full assortment of tools. Where the vertical spread is going to be one of those strategies like a hammer, in a sense that you're going to use it a lot on the job. Every once in a while, you've got that one tool that you only use for a specific job, and it's actually used rarely. That would be the straddle. It's not something we're going to use every day, but there is a time and place for it, so it is important to understand how and when to make money off the long straddle.
All right, Ron, they have a pretty good understanding of straddles now, and now they can make money when stocks are about to break out or break down. But the next strategy is the strategy I always think about whenever I see Ron walk into the room. It's the strangle. So we're going to cover strangles next in the next DVD. Before you pop that in, go to the community at optionsgps.com, talk about straddles. Don't jump into the strangles yet before you cover that and you know that you know the material. Take the quiz, pass the quiz, and I'll see you on the next DVD.
Okay, Chris has found us an opportunity in Pfizer where we have an opportunity for the stock to either break out or break down. Now, we don't know which one it's going to be. So we can't lean long because it might break down. We can't lean short because it might break out. So what do? What we need is a single strategy that allows us to make money if the stock moves big in either direction. The straddle. We're going to straddle this Pfizer stock. What are we going to do? Well, with the stock trading at 13.58, we have the 14 strike here. What our next move is to buy both the 14 call and the 14 put. By doing that, if the stock runs up, hopefully the stock runs up enough where our 14 call makes more money than we lose in the put and beats the break even of the call also. Don't forget, we have to add the price of the straddle to the strike to get an upside break even, and we have to subtract it from the strike to get a downside break even. Inside those break evens at expiration, we're going to lose on the trade. What do we need? We need the stock to move beyond either break even for us to make money. Now, in doing so, we're looking for either the stock to run up enough to have this call take off for us, or to break down and have the put take off for us. Doesn't matter which one we get. This is a directional strategy, but it's called an undefined directional strategy, meaning that we don't have really a lean or a want of either direction. We have a one of both. Now, why are we doing the at the money? Well, if we go do the at the money, we are assured no delta, which is great because we don't know which way it's going to go. We don't want to be caught leaning the wrong way. But with no delta, how are we going to make money if the stock moves? Gamma. The secret to the straddle and the upcoming strangle is going to be the gamma. The gamma is going to acquire deltas for us, and it's going to acquire the right deltas for us no matter which direction we go. Why? Because we're buying options, and by buying options, we become long gamma. And long gamma is always right in its direction. It's always doing the right thing. It's selling constantly for you on the way down, buying on the way up, always in the right direction. And that is the secret to this trade. That's why we need that front month at the money, because we need the heavy gamma. Because as the stock moves, we need our position to gain deltas for us quickly so that we can beat our break-evens and make money on what is normally an expensive, low-probability trade.